Hello, everyone, and welcome to the NASP MITA webinar summer series. My name is Ron Parker, and I have the pleasure of being the President and CEO of NASP. I bring you greetings from Amrik Shaha, the Managing Director of MITA Advisors, LLC, as well as the Board of Directors for NASP and the Board of Directors for MITA as well. This is our summer webinar series where we bring to you some very important topics to be discussed and be shared with our members and our strategic partners. But before I turn the program over to our moderator and to our fantastic panel, I would just like to take a few moments to really thank some people who've been working hard behind the scenes to bring you this particular unique webinar. They are Amrik Shaha, the Managing Director of MITA LLC, also Melanie Swartz, Yipsera Zudi. We also have Lee Stevens, who's a member of the NASP board, as well as Marche Hall, Director of Programs at NASP as well. So they have been working hard to bring to you these types of programs that are beneficial to our members and our strategic partners, as well as to our partners in investing. Now, I have the pleasure of introducing a fantastic moderator who's going to take us through the panel discussion with some very, very talented leaders from around the world. It is with great pleasure that I introduce to you Nadine Minter. Nadine is the president of Minter Holdings and Investments. She has over 17 years of international experience in investment banking, as well as financial management in global markets. She's a board member of NASP, but she's also an advisor to MITA LLC. Ladies and gentlemen, I give you Nadine Minter Williams. Nadine.
Thank you so much, President Parker. Thank you, and I really appreciate that wonderful introduction. Welcome, welcome, welcome to our summer webinar series. We're so excited to continue our series with the case for investing in Africa. This afternoon, this morning, this evening, wherever you are joining us from, we're excited to welcome our global community. I look forward to moderating this discussion today that's really focused on supporting and delving into the groundbreaking Mercer publication that we first published back in 2018. We will explore different opportunities for investments in Africa, and we will focus on key themes from the publication, highlights from the executive summary that was received during the registration process that are relevant in today's African financial market climate. At MITA, we are very proud of the work that we have been able to perform with USAID and Partner and Prosper Africa. The success that we've had in educating, connecting, and facilitating investments into Africa is because of the partnerships and relationships that we have with organizations like USAID, like the US mission offices in the respective countries that we work with, like Prosper Africa, NASP, Invest, Mercer, and Standard Bank. Collaboration promotes progress, and progress leads to transactions. The Mercer publication represents the importance of strong collaboration to mobilize investment for infrastructure and developmental impact. The first Mercer publication that was first published in 2018 was funded by USAID. This was critical to the progress made to date. To date, we've seen investments from US pension plans, including San Francisco Retirement Plan, Texas Teachers, Chicago Teachers, Alameda County, and the Casey Family Foundation. Most recently, we saw the city of Hartford come in and co-invest alongside Kenyan and South African pension plans. This is part of our objective here, to facilitate investments, to provide market insight, and to identify innovative structures so that there are opportunities for different type of investments and investors to come into Africa. Today, I'm excited to be joined by 3 experts in the field of investing in emerging markets, specifically in Africa. First up, we have Max Mercer. Max is a principal in the Sustainable Investment Group at Mercer, which is a leading asset management consultant in 44 countries and 130 countries globally. Max has over 15 years of experience in ESG, advising pension plans, institutional investors, and different type of investors globally on opportunities in sustainable investment. Next up, we have our one of our wonderful partners again. We have worked a lot with Standard Bank, Shola Agdebasan, which I am hoping my Nigerian brother will also share a little bit about, being in the continent and what that means in terms of investment opportunities. Shola is an executive and the head of global markets flow sales at Africa at Standard Bank. Shola has over 20 years of experience in financial markets. He is on the ground with regards to innovative transactions, understanding different client needs, and bringing together investors, as well as facilitating relationships when it comes to Standard Bank on a global markets. And he is critical in the progress that we have been able to make to date, working in South Africa, Kenya, Nigeria, and other countries in Africa. And finally, we have our principal advisor at Meta Advisors, Mr. Dan Bond. Dan has over 30 years of experience working in emerging markets, including with insurance companies, with the World Bank, with institutional investors. Dan has been critical, not only working with USAID, but also helping to create what we have been able to establish here at Meta, working with NAS, working with Meta to facilitate relationship building with institutional investors and identifying opportunities for our investor network, including within the Advisory Council, to learn more about investing in Africa and being informed about investing in Africa. So I am excited about our panelists that we have here today, and we want the next hour to really be a conversation about opportunities to invest in Africa, a conversation that we encourage you to join us by submitting your questions in the chat. Please utilize the chat, and we will have a Q&A portion at the end of this hour. But first up, we want to learn more about the Mercer publication. And so my first question is, what is the Mercer publication and why was it first produced in 2018? Max.
Nadine, thank you. And thanks everyone for joining us today. We're thrilled to be back speaking with the NASP audience today. I had the pleasure of speaking with your group back in 2018 around the launch of the previous report, and was really a pleasure. So I guess to go back to the original report, the purpose of that document was really to investigate the barriers and opportunities for increasing institutional investors' allocations to specifically looking at Sub-Saharan African infrastructure investments. And so as part of that process, we interviewed 11 leading infrastructure investors globally, 7 asset owners and 4 asset managers who collectively controlled around $1 trillion in assets. And what we wanted to understand from them was their kind of perceptions, their experiences, to the extent that they have any experience investing in African infrastructure and real assets more broadly. So what we found from those conversations was really a broad range of perceptions, but really the kind of key issue was really was this risk perception and reality gap that we identified. There's this perception that there is a higher risk investing in African infrastructure, for example, than other regions globally. That typically has not been borne out, and we presented data in that report to show that by investors' experiences. And it is a challenge always to find data that will always assuage every investor's fears, but that was one of the gaps issues that we found. In addition, we found that there's a necessity for patience, long-term commitments in making those investments. Investors who sought that exposure needed to really kind of gain exposure themselves, get comfortable, travel to the continent, visit other investors, look at project sites. And that's kind of a key function that I know we'll talk about a bit of the role that Meta has played in advancing the conversation with U.S. institutional investors here. So really the purpose of that report, again, kind of highlighting those challenges, highlighting some of the opportunities there. So this 2021 version of the report, or I shouldn't say version, but new edition, really is to demonstrate how those barriers have been overcome and what impact has been achieved along the way by institutional investors. And so what we sought to do with this paper is really, I should start off by saying, when this final paper is reported, it's going to be quite sizable. I think we're clocking in at around 100 pages in length, which might be shocking. But the point of it is that it's a reference document. And what we provide is a huge amount of really useful and insightful information, starting off with a kind of the macroeconomic perspective on the case for investing in Africa. It's provided by the Standard Bank Group senior political economist, Simon Fremantle. And he identifies kind of and outlines 4 different trends on the continent that really collectively make the case for investors seeking kind of focused exposure to the region. And then furthermore, we go into what we're going to speak out about further, but really an unprecedentedly deep and nuanced case studies about actual investments that have occurred on the continent that Dan here on our panel today, conducted dozens of interviews to support and really got really in depth and in the weeds about what happened there, who was involved, kind of the ebb and flows of those transactions. So it's really truly an incredible set of information. And then finally, we look at impact investment trends on the continent, and also outline different opportunities for international investors to gain exposure, seek partnerships on the continent. So all this we're going to be talking about today on this panel. So I'll stop there.
Fantastic. Thank you so much, Max. We appreciate your feedback. And Dan, I know that you have been critical in terms of the collection of the information, the facilitation of the information for this publication. Why do you think this publication is so important right now? You're on mute, Dan.
Yep. The natural next step was to get into more detail with particular projects that have been successfully undertaken that have involved the private sector and institutional investors, so that people who are interested in investing can see how it's actually been done. So we chose 5 sort of benchmark programs or projects in Africa. We looked at them in depth. In the year of COVID, we did one-on-one interviews, had great support from Standard Bank in setting up interviews with people who have been involved in these projects. And through that process, we were able to put together a lot more detail on how these projects were originated, structured, financed, with a particular focus of how do you bring institutional investors into the projects. Let me just very briefly mention the 5 that we covered. They were in different countries and different sectors. The first 2 were in Nigeria, and the sequence here I see is not the first 2, but we had 2 Nigerian projects, the Azero Edo Independent Power Producer Project, a major project involved World Bank and private investors working together, and the Jabi Lake Mall, which is a real estate investment project in Nigeria. They were very indicative of how traditionally projects of this type have been put together in Africa. In Kenya, we looked at the Acorn student housing green bonds that were issued recently. This is a path-breaking development in the use of project bonds for financing in Africa, an area where there's been very little use of project finance. And the Acorn student housing transaction, which was successfully completed, is, I think, the first of a number of projects that are going to be developed in Kenya on a project financing basis. In other parts of the world, project bonds, municipal bonds are a primary means for pension funds and insurance companies to be able to invest in infrastructure. Normally, they're put together as refinancings after construction is completed. The bonds are issued to take out the initial equity and debt of the project sponsors, and they provide a good instrument for institutional investors who are buy and hold, looking to do asset liability management by using the bonds to generate long-term, often inflation-adjusted, uncorrelated assets in their portfolio. Another path-breaking effort was the Climate Investor One effort that is ongoing. It's a platform that has reached scale in financing infrastructure. This platform, Climate Investor One, is a whole of life financing solution. It involves a blended financing approach, especially for the early stages of project development and project construction, and then transfers into, for the operating projects, investing by institutional investors through a debt facility. It's one of the largest scale efforts for financing renewable energy across Africa and Asia, and it's a true path breaker, we felt. Another very important development that has offered and will be offering opportunities for institutional investors is the Renewable Energy IPP program in South Africa. This program, which has gone over 10 years now, has had multiple issuances or bidding processes for independent power producers to bid on producing electricity through renewable energy, wind, solar, other sources of energy in South Africa. It offered a lot of opportunities for African and institutional investors to invest in these projects. And there now is a sort of a second stage going, with the 5th round coming up soon, that is going to probably require a lot of refinancing of the operating projects. And we hope that we'll begin to see project bonds and other sources, other types of instruments that will allow institutional investors to invest in these operating projects. This is a very extensive program and a very successful program in South Africa. So these 5 case studies take up the bulk of the report. We try to provide detail that is often hard to put together from just your normal publications or press releases, by interviewing the people who were involved, and they were very generous of their time and talking about their projects. And we think it'll be a resource for people who want to really understand, how do you do this? How do you put the pieces together? And also we talk about the risk and the problems that each of these projects faced, or these programs face, and we'll address that in just a moment in our discussion. Thank you.
Thank you, Dan. Definitely appreciate it. And you are absolutely on point with regards to providing a framework and how do you get this done. We are fortunate to have many institutional investors on the webinar listening in right now. And so we want this time to be spent with how do you use this information and what are the next steps? And we will help you provide that information so that you can go back to your respective organizations and have the tools, have the resources in place to move to the next step in terms of how do you start the investment process. Shola, from your side, from Standard Bank, I know that you've been involved in many type of transactions. All of these transactions have been tied to Standard Bank in one way or another. From your perspective on the ground within the bank, how do you see these opportunities and this current environment flourishing? How do you see investors getting involved in these opportunities?
Yeah, okay. I was struggling with the unmute button there. Thank you very much. I think to your question from a Standard Bank perspective, I think the first thing I'd like to note is that this is a very, very opportune time to look at Africa. I've been in this market well over almost 20 years now, and I've seen different cycles of focus on Africa, but more recently, something has changed where the opportunities are no longer looked as transactional opportunities, one-off opportunities. This is the first time in my career that I'm seeing the focus has changed to more of a structural change in terms of education, in terms of the way the policies, in terms of bridging the gap between the offshore investor and the onshore investor. I think the slowdown we saw was just when the COVID happened. And between that time and now, we've seen sort of a significant drop in infrastructure investment on the continent. But we're very optimistic from a Standard Bank perspective that once we get through this cycle, once we get past the pandemic, to the point I raised, we're beginning to see a structural shift towards a genuine interest in long-term investment into Africa, unlike what we saw in the past, which was more transactional, which was more portfolio driven and more around market securities. We've seen a significant growth in interest to invest long-term substantial projects on the continent. And I think like I'd said before, once the pandemic is over, we do expect to see that growth to continue sharply.
Those are very important points. And going on to some of the challenges that we've seen on the next slide, we're going to highlight a few of those challenges and how do we address those challenges. Shola noted that COVID, obviously the ongoing pandemic has been a challenge not only within Africa, but globally. But what are some of the challenges to investing in Africa infrastructure specifically that we can share with our audience today? Max?
Sure. Yes. So in this case, we list a number of those challenges identified through conversations, through additional research that we've conducted. And a lot of these, to be frank, kind of track to some extent with our prior reports. I don't think that the intervening 3 years has radically shifted this issue. And really what we're trying to get at here is identifying, again, this risk perception we spoke of before, and this limited availability of risk mitigating, vehicles or measures. And, again, so what we're talking about here is, particularly with the institutional investors that we've interviewed, typically have little experience investing in African infrastructure and, generally perceive these risks to be high. To get an institutional investor to begin to allocate in a more focused way to the African market, rather than maybe having some exposure through, global emerging markets vehicles, really takes this education piece, takes this kind of engagement with the topic, and beginning to understand, the unique kind of opportunities that are there. And so really what we want to do here, again, I think MEDA has done great work in bringing, as you mentioned, a number of different trips, for institutional investors to visit the continent, visit projects, visit companies, meet with other investors there. And that's been a key piece of, I think, unlocking a lot of opportunities, a lot of investments that you noted at the outset, Nadine. I think that's happened in the intervening years, and even prior to the first report's publication. I'm sure that MEDA will be continuing that, again, pandemic issues notwithstanding. So that's one key issue there. There are ways to mitigate these risk perceptions, though. Seeking to find kind of long-term revenue, contractual kind of arrangements, power purchase agreements, for example, in the energy sector, minimizing demand and pricing risk. Many projects can be U.S. dollarized or have been U.S. dollarized, which minimizes currency risk to some extent. And then, of course, there are also many different tools out there available from development finance institutions. And, again, typically the average U.S. institutional investor may not be as familiar with the DFI kind of community and what is available from them to help mitigate some of those risks. And of course, Dan, writes really well about a lot of these innovative new vehicles for risk mitigation that are out there as well. The limited investment vehicles, typically there's just not as many, let's say, funds out there for your average asset owner to invest in compared to other regions. However, we see that is changing to some extent. There is some growth there. And as Dan noted in his earlier comments, the development of, for example, bond financing for projects, project bond financing is really, it's nascent. I know he'll probably have more comments on that. But as this does develop more for different projects on the continent, that will provide a whole new stream of opportunities for institutional investors to look at. And then, the other pieces there, gaps of financing, there's few kind of commercial debt and equity providers on the continent, so there can be sometimes a higher cost of capital for projects. And so, the concessional funds from governments and DFIs can be used to crowd more private investment, as we mentioned, can help mitigate some of that. But again, issues there. So, and then finally, the fragmented markets. As noted, there's 54 different countries in Africa, of course. And while there is some efforts in certain regions, certain countries to, particularly on the regulatory side, to allow local pensions, for example, to invest more into local infrastructure projects or perhaps regional infrastructure projects. there isn't always corresponding regulations between different countries, so that if you have, a project that may cross country borders, it may be more difficult to finance in that respect. And therefore, again, the opportunities are correspondingly more slight. But there's a lot of challenges there. I don't want to overstate the case, because there are absolutely benefits, as we're going to speak to, and opportunities. So.
No, definitely. And I think it's important, and everyone would agree, to make sure we understand the challenges, be as informed as possible before entering into a transaction. One of the things I would like to note is, USAID DFC's efforts in addressing some of these challenges, coming in and working alongside investors for opportunities to co-invest, opportunities to go into impact investing sectors like housing, women empowerment, financial inclusion, jobs, education. The USAID as well as DFC have been critical in terms of addressing and helping to fill the gap in some of these areas, as we have worked with them, as well as with Mercer, as well as with Standard Bank, on some of these impact areas that we really want to help address. With the Pan-African Women's Impact Fund, the Women Impact Fund, with the We Greater Than Me program, as well as with the housing program in Lomé as well. Shola, given your experience and your background addressing some of the, whether it's the interest rate exchange risk, some of the foreign risk, do you have anything else to add on this page?
Well, I think one other challenge, which again is to the point I made earlier, is beginning to change, is around the regulations and the policies that have been in our markets for a while. These have been largely unchanged and not up to date with recent times. But the big change we're seeing now is we're seeing a more responsive regulators in most of the countries, where in the past they were a lot more rigid, but there's now a sense of listening and a sense of wanting to find out what's happening in other parts of the world. And I think once we do the education around how things should be done and how our markets should be governed, I think it will open a lot of doors and a lot of opportunities to do more on the continent.
Well said, well said. And so we look at innovation, we look at new developments, new opportunities, and Dan is going to walk us through a few of the new opportunities and developments that will be highlighted in the report, further in the report when it's released later this year.
Thank you, Nadine. The 5 case studies, as I mentioned, are basically projects and programs that have been completed, and very successful programs, bringing in institutional investors. And when you go through it, you'll see that one of the primary ways that investors from the United States and other developed countries have invested in Africa, and also local investors in Africa have invested, is through funds, infrastructure investment funds, where they are limited partners in a fund with a managing partner who has experience in project acquisition and exit and so forth. That has been sort of the primary vehicle. Now, that is a good vehicle in many respects. You can get good returns, you can have positive impact, but it really does not normally deliver what has been touted as the benefits of infrastructure finance as a new asset class that is different from what is already in your portfolio, that is not as correlated with other asset classes, and should be treated as a separate asset class, and is being treated in some regulatory environments, like in Europe, as a distinct asset class. This is an area that there's a lot of work going on. Everything is sort of tentative at this stage, I think, that is coming up with new ways to invest that give the benefits of infrastructure that infrastructure can provide as an asset class. That is basically long-term investments with rather steady cash flow, often inflation adjusted, and not really correlated with the business cycle and other types of investment. So it was important, we felt, to talk about these types of developments that are on the horizon or just beginning to be tested. And they often involve things like project bonds that I've already mentioned as being one vehicle. But we wanted to look at this type of development and some other developments that we felt were very important. Another challenge, and Shola touched on this, is going from a project by project sort of boutique approach to financing to more portfolio wide or standardized programs of financing. Certainly the REIPP, Renewable Energy Independent Power Producer Program in South Africa was an example of a program that had a good deal of standardization in it and therefore was very successful in getting a lot of investment going rather quickly. But there are other approaches. One of the approaches we touch on, and these additional developments, we don't go into as much detail and depth as we did in the case studies, but this development is the use of credit risk transfer techniques, what you might call a securitization vehicle that can take a bank's projects financing or other forms of financing, and on a portfolio basis, transfer the credit risk to institutional investors. A very successful use of this technique was African Development Bank's Room to Run program that they undertook, where they took a set of assets on their books and through a synthetic credit risk transfer had these purchased by institutional investors. One of the advantages of that program was it left the African Development Bank fully in charge of the management of the projects. All they did was transfer the credit risk, not the responsibility of dealing with the projects themselves. And it's very important to recognize that institutional investors generally are very passive investors. They do not have the ability to structure, monitor, manage, remediate a project. They can provide a lot of money, especially debt, which is critical for infrastructure project financing, but they are not very active. And therefore, having a structure where they provide financing, but leaving the banks largely in charge of the management of the projects, sort of participating in the bank's work in doing project finance, is a very promising approach. And we expect to see more of these types of credit risk transfer transactions going on in Africa. They're very common now in Europe and in North America. African Development Bank's Room to Run was one of the first of these in Africa. Another approach that is talked about a lot, it's really been around for a long time in reality, is the use of public concessional finance together with private finance and expertise in financing projects. This is blended finance, as we now call it, the new name for it. And blended finance is particularly appropriate for Africa because oftentimes it is not possible to structure a project to deliver a needed public resource like water or highways and finance that by collecting tolls or revenue from the customers. So there may have to be revenue support, and that's something that a lot of the blended financing structure provided. There may need to be risk mitigation in various forms. And another way that this is done is by having the private sector co-invest together with the public sector. Africa 50, which has been launched by the African Development Bank and DFIs and countries, governments in Africa, is attempting now to bring in private financing to work with them on infrastructure projects in Africa. So we look at the Africa 50 effort. It's been mentioned already by Max that exchange rate risk is a real bugaboo in oftentimes when you're dealing with projects in Africa that are generating revenues in local currency, but to get the long-term lower cost financing they need to make them feasible, they have to tap foreign currency lending. That leaves them taking a very big risk, which is exchange rate risk. There needs to be a lot more work done in this area, but one of the more promising approaches, because it approaches this on a portfolio basis rather than an individual project basis, is the currency exchange, TCX, which was launched by FMO and Cardona and has now had a number of years of experience and is growing in size. And as more institutions start using the TCX program for exchange rate mitigation, the more successful it will be. Really, it has to scale up. It has to scale up to where it can do more than just small projects to large projects, and also where they can bring the cost of the risk mitigation of exchange rate risk down to more reasonable levels. But that's a very important development. We think it's going to go forward and grow and become more and more important. Let me skip to the last one here, the collective investment platforms, because this is where MEDA is very much involved, working with USAID support and also working with the World Bank on this, is helping pension funds in Africa, local pension funds, come together to share information, to educate each other, and to look at investments as a group to reduce the cost of investing. They also potentially have the ability to pool their assets so that they can invest at larger scale. Fragmentation of the pension funds in Africa is a problem. A lot of the pension funds are small. It's very difficult if you're a small pension fund to invest in infrastructure because you would have concentration risk probably before you fill up your portfolio with as much infrastructure as you would like. So by pooling their assets and investing them collectively, there's a lot of potential for more pension fund investing in their own domestic infrastructure. And MEDA has worked with the pension funds in Kenya to help form the Kenyan Pension Fund Investment Consortium. And we're working in South Africa with the Asset Owners Forum of South Africa to do just that. In addition, we're linking them to the NASP membership to exchange information, to collaborate, hopefully to invest together more in the future. We feel that US pension funds investing in Africa can benefit if they have partners in Africa who have local knowledge, provide, I think, some political risk protection, because governments are not going to be so perhaps invasive on a project if they have their own countries and pension funds invested. And then the pension funds in Africa can learn from US pension funds how they invest in infrastructure and what kind of instruments they have found useful and the research they have done on this. So it's a mutual learning experience and hopefully investing experience. And this is an important development. We think it'll be spread. We're looking next at Nigeria to do something like this. And I think this is a development that is going to bring the African and US pension funds working together to provide a lot more impact. Thank you.
Thank you so much, Dan. And that's what we're looking for. We're looking for impact and bringing the resources, the education, and the relationship building together. I know that we have quite a few of our institutional investors, our advisory council members who are on this afternoon. We want to say thank you so much for joining us. And also, Max mentioned the delegation trips. These delegation trips were critical for the on-the-ground education and helping to facilitate those relationships with not only the asset managers on the ground, but also some of the partners, the stakeholders. So again, the more we understand the different areas that we're seeking to invest in, the more people feel comfortable investing. And so the opportunities to connect and regroup and be able to restart those delegation trips again once it's safe. Again, we thank USAID and we thank Prosper Africa for the opportunities to do that. We talked a little bit, and thank you, Dan, for talking about the additional developments and some of the highlights from the publication, but also talk about, what are some of the next steps? What are some of the solutions and the practical solutions to investing in African infrastructure? I'm not sure if Shola is going to take the lead on this, but really talking about what can asset owners do now to start that process? Because as we all know, it's not an immediate result. It takes time, it takes investment, it takes support. So what can those people that are on the call now, again, we have people on the call who have invested, but we have people on the call who are interested in investing and they are not sure how to start.
So I did see on one of the questions on the call, someone did make the comment around how Africa is on the wait for most of the large pension funds and who's going to do the work to explore the opportunities. And I think that leads to the very first point on this slide, which is the education. The fact that Africa has not been a prominent part of most portfolios does mean that there's less attention to Africa as an opportunity. And I think the work MEDA is doing, the work we've been trying to do from a Standard Bank perspective will go a long way in educating the pension funds, the foreign investors in understanding the African story. And there's a saying in my language, and I'll phrase it basically. It says, and I'm sure there's an English version of it, but it basically says, the bad news travels much faster than the good news. And I think that's typically the story of Africa, where the bad news has gone so far ahead of the good news that, in fact, nobody even knows the good news is still in the race. So I think our job is to try and bring the good news forward, let it catch up. And seriously speaking, there's a huge opportunity here. The gap is trying to bridge that lack of information and the lack of conformity of how the opportunity looks in Africa to what the foreign investor recognizes and would understand. And I think it leads to the second point, where we have to leverage the partner relationships. This partner relationships would include the sort of work MEDA and Standard Bank is doing, where Standard Bank has huge expertise on the ground, knows what it looks like, knows what the risks are, but we don't have as much sight into the offshore investor. Whereas MEDA has sight of the offshore investor, understands that market, understands what the offshore investor would be looking for and would be concerned about or would attract the investor. And I think coming together this way will try to bridge that gap that has existed for years with regards Africa. The other thing that I also missed around education is also domestically, there's a need to do some education domestically, because within Africa, we've been sort of insulated and we've always approached things from an insular perspective. And I think to the point I made in the earlier on around talking to regulators, talking to even the portfolio investors here, as to what the possibilities are, as to how we could go about things in a better way, and how to open ourselves up to the rest of the world is something that we are trying to do significantly. So the role of education and information in providing the solutions, even before the products, even before the opportunities, cannot be understated. I won't go through the whole list, but I think one other key thing that comes up, and I'm sure Max and Dan will chip in, but one other thing that significantly comes up is risk. In my personal opinion, I think the risk of Africa is highly overstated. There is risk like every other investment, but I think that lack of information has heightened the view of the African risk. Now, there's also risk that is created by lack of structure, lack of development in the markets. And as Standard Bank, there are three ways we've approached risk mitigation. One could be simply where there's market development and there are market traded ways to buy that risk and cover it. That's the simplest. In other ways, we go about it tactically, where we create solutions, bespoke solutions for those particular scenarios. And then the third is working with DFIs, working with governments, especially around projects that have a social impact, whereby we leverage their interest in this project to subsidize and underwrite some of the risks in the market. But I think the key point there is market risk. It's somewhat, in most cases, looks strange for a foreign investor. But the more important thing is that this risk can be mitigated and have been mitigated in the past. And there are lots of examples of how other projects have found ways around this risk. I don't know if anybody else wants to chip in on some of the other solutions.
Thanks, Phil. I actually absolutely would. And I think that the risk question is an interesting one, because in the first report we found, and this is also certainly reflected in this latest forthcoming report, that investors who have exposure on the continent already, U.S. or Canadian investors or others from the European side, frankly are quite comfortable with the risk. They're happy with the returns. They plan to generally in surveys say that they plan to maintain and oftentimes increase their allocations to their African kind of portion of their portfolios. And this is reflected in a lot of different surveys from an impact investment perspective, which is kind of term we've touched on a little bit here. The Global Impact Investing Network, for example, they do surveys, every couple of years, and they found that 52% of respondents in their latest survey indicated plans to increase their allocations to Sub-Saharan Africa within the next 5 years, and a further 33% plan to at least maintain their allocations to the continent. And then a further 10% said they'd begin to, assess whether they might make an initial allocation. So, what we're talking about here is 85%, and really, already are quite comfortable with where they are, and the majority of those are planning to increase their allocations. And this is the highest out of all the different kind of global regions that they looked at. I think it was close second, or excuse me, just ahead of Southeast Asia, for example, as another kind of key impact area. So, there is this interest out there. And again, so those who are on the continent already, frankly, are quite comfortable. And this was reflected in the interviews that we've had with quite a number of investors as well.
I think one other point I also wanted to add was, oh, sorry, Dan, one other point I wanted to add also was around the information gap. Is many people don't realize, but though in Africa, there are much smaller projects and smaller number of projects being done, but the default rate is actually one of the lowest in the world right now.
And I would like to add that maybe it falls into the education. Our perceptions lag, usually at least 10 years. And in an area like Africa, where there were a lot of problems with the quality of regulation, with the speed at which governments could put together projects and bid them and actually get going, perceptions of people who don't go to Africa, who don't work on projects, is probably what it was like 10 years ago. Well, there's been a lot of progress in most countries, not all, and there's a lot of difference in the speed of the progress, but regulations are better, more stable. Governments realize that it takes stability and clarity and a good judicial system to make project finance work, and they're making a lot of progress there. So anyone looking at Africa, you need to be in contact with Africans and learn what the current situation is, not what you heard 10 years ago and doesn't keep up, and stories don't get published that keep you informed. So catch up, find where Africa is today, not where it was yesterday.
Very good point, Dan, and very good point, all. Max, I'm really glad that you talked about, continuing to invest. Even during COVID, we're still seeing institutional investors still investing. And so it's not that it's stopped. It's not that Africa has stopped. Africa's, again, 54 unique countries, and some of the top growing, fastest growing countries. When you talk about population, when you talk about youth, when you talk about the employment, when you talk about infrastructure development, there are opportunities across the spectrum in Africa. And so thank you, Shola, for highlighting that and the importance of the information gap, the importance of addressing that and making sure that we're talking about Africa today and not Africa from the 1980s or the 1990s. So very important points. We have already started to answer some of the questions. Thank you, Shola, for reading the chat and addressing some of the questions already. Before we get into the questions, I do want to make sure that we know, what can you do now? What's the next steps? We talk about information. One of the best ways of informing, getting information is through the networks at MEDA, through the networks at NAS, through the network at Mercer, our networks at Standard Bank. Again, you have resources, you have relationships, you have partnerships, and we can help connect you with other organizations who are looking to co-invest. We can help connect you to innovative solutions in terms of risk mitigation and investment structures. So it's not that the information is not there, it's just needing to connect with that information. So we are here and ready to work with you, and you're not walking this journey alone. You have advocates and you have supporters, because we want to make sure that you understand and your organization understands the benefits of investing in Africa. We do have a couple of questions that came in the chat that I want to make sure that we address. Someone did ask about the report. The executive summary is out right now. You have access to that through the registration link, and the report is scheduled to be released later this year. I'm not sure if Max wants to give us an approximate time frame.
Sure. Yeah, well, no, we're thinking mid-September, we're planning a series of rollout events in partnership with Standard Bank around that. So, you'll surely see information about it shortly, but more to
Very
come.
good. Thank you. So we're starting mid-September. So be sure to follow us and log in and make sure that you are part of our distribution so you can get the report when it's released. Cedric did ask, hi from Mauritius. Welcome, Cedric from Mauritius. We know that it's late in Mauritius right now, so we thank you for staying up. Is diversification an important element in your portfolio construction? If yes, how do you deal with it? I'm not sure if Shola or Dan, if you guys want to address that.
Well, I can address one aspect of it, certainly. That has a lot to do with the way you invest. If you invest in an infrastructure fund, you can make a modest size investment and get diversification through the fund itself. So most funds are diversified, oftentimes across multiple countries in Africa or even across the emerging markets. And so you get some diversification there. For direct investing, it's a little bit more difficult, although I mentioned project bonds are an instrument that allow even a smaller pension fund to get diversification across multiple projects fairly easily, because you can, with a bond issue, particularly if it's listed. Now, sometimes unlisted bonds are a little bit different, and most project bonds are unlisted. You can buy a modest amount and build up your own diversified portfolio. So there are ways, both with indirect investing through funds and direct investing through project bonds, that are good ways to get a diversified portfolio where you don't put all of your eggs in one project. I think that's the problem you see for a lot of pension funds. To be able to get into a project, they have to put enough money and they really use up their allocation for infrastructure, and it's all in one project. You do want to avoid that.
Very good point, Dan. Very good point. I'm not sure if anyone else wants to add to that. We have a few other questions coming in. Not seeing anything. Shola already talked about risk. Ms. Leeds Lindeka, she asked about foreign currency risk and hedging solutions. Shola, you highlighted a little bit about that. I'm not sure if you want to expand further.
Yeah, okay, I could expand further. I think the big gap that most offshore investors meet when they come to Africa is the expectation to have market traded prices for risk mitigation, which we don't have in most of the markets. But that said, it doesn't mean it's not possible to mitigate foreign exchange risk. I think what the big difference is that for large infrastructure projects, for example, the way to mitigate it would be probably the same products the foreign investor is used to, only that it will have to be created synthetically. So it won't be taken off an exchange and the bank, and that's what we do in Standard Bank. We would actually create those mitigations synthetically. But one of the points I also mentioned is that there are other tactical ways that we've also come across in terms of mitigating the foreign exchange risk, especially in the markets that are very small and the depth is very low. But what we go about doing is either through the social impact interest of that project or through the customer flow of Standard Bank, we have ways of creating tactical solutions to the foreign exchange problem. So it is a problem, it is something that exists, but I think the key point here is that it can be tackled. And I have seen in my experience that the more of these problems that we solve, the quicker we get to a point where we have a developed market where these things are then commoditized.
Well said, well said. Definitely appreciate that and agree with that. A couple of comments, Cedric. Institutional investors need a partner that can make their voice heard as well in those investments. Very, very true. And we want to make sure, again, that institutional partners feel valued and understand what they're bringing to the table, as well as understanding the investment that they are investing in. So agree with that. Aubrey, go ahead, Max, sorry.
Nadine, I was just going to say there's a question that came in, and it came just to the panelists, so it may not have been seen by all, but just from Miguel. Says Africa is a small allocation based on index size. It appears investors aren't driven to do the work to explore the opportunities. And how is Mercer encouraging client portfolios to consider and allocate to this region? So obviously, since it's directly asking me, I wanted to speak to that. I mean, part of the way that we're encouraging our clients to consider, make an allocation to Africa, and specifically, let's say, I think to a number of comments here, one or multiple of the 54 countries, to be quite clear, they're not all a monolith by any means, is really to do work like this, to partner with find partners who we can do in-depth research with, we can create reports that we can present back to our client base. And furthermore, something else that we've done is we have, a really robust network of over 200 different asset class research specialists who do manager research for asset managers around the world. And in a number of cases, of course, we keep track of, we have certain manager researchers who, of course, are tracking Africa as part of their regional kind of coverage. And so they're looking at funds that are being launched from African asset managers. They're looking at what they're doing, keeping track of those that they believe to be, really well positioned to advance their clients' interests, help them, realize, gains and, create some alpha. But then furthermore, really do diversify their portfolios as a whole. And one would hope also create some positive social and or environmental impacts for the communities, underlying it. So, really, we do have a track record of researching and rating a number of different funds that have come that have kind of a regional focus on the continent, particularly from an infrastructure perspective. We plan to continue to roll that out. I mean, I think there's a huge amount of innovation happening that we've been discussing already, and the opportunities are growing. So we plan to increase that. And I think one other piece I would mention simply is just that we do have a strategic relationship after a number of years now with Alexander Forbes in South Africa as a leading institutional consultancy down there. So, we have a relationship there and plan to continue that and really kind of, again, bring intellectual capital to bear as well as investable opportunities to bear for our clients.
Very good, Max. Thank you. Thank you, Miguel, for that question. And Max, I wanted to make sure we highlight that there is an impact section of the report that Mercer has contributed to the report. So impact specific, the importance of impact, the importance of ESG, these are all very relevant, especially in today's environment. So I know that was a question that also came up. We only have a few more minutes left, and I know that a couple of questions just came in. Aubrey, I just want to highlight, we wholeheartedly agree with you. Africa is 54 unique countries, unique regions, unique cultures. And so again, it goes back to education, information, and sharing of that education. Just time for probably one more question before we get kicked out, I should say. Do your institutional clients invest only in traditional infrastructure, or do they also look at non-traditional social infrastructure like health and education? So the short answer is yes. Also, how interested are they in investing through private equity and alternative asset classes? I'm particularly interested to understand how African pension funds can be motivated to utilize their allowed allocations to PE. Who wants to take that before we wrap up?
One piece I just might mention on this that we've touched on is for example, the KEPIC and Asset Owners Forum in South Africa kind of development of these kind of collective consortiums for sharing information amongst asset owners in those two respective countries. And I know, of course, MITA has been doing a lot of work there, as Dan has mentioned. And so I think that that information sharing and moving as a collective group seems to be very positive. And we did conduct interviews with two key members of each of those groups as part of this report to really gain their insights. And they're very, bullish, frankly, on the opportunities there, as well as for the regulatory hurdles to be overcome that Shola has rightly brought up.
And I know that this is a lot of information in 1 hour, but we have the opportunity to share more information at our next event that we're hosting with NAST. NAST is upcoming conference, the African Emerging Markets Summit. It's September 22nd to the 24th. This is a virtual virtual conference. It's NASA's 32nd annual Financial Services Conference. You do not want to miss it. We are going beyond talk. We're talking about leadership, action, and impact, and how you can get more involved. And so I think Marche has already included it in the chat. If you can drop the link again in the chat, please click on that link. There's opportunities, there's information, there's education, there's networking, there's relationship building. This is a great, again, moving it to the next step. Collaboration promotes progress. And so for us to get to that next step is, again, learning about what's going on, understanding Africa as a whole and Africa respectively within each country, and then also getting involved. So get involved in NAS, get involved in MEDA, connect. If you're in Kenya, if you are in South Africa, connect through the Asset Owners Forum in South Africa, through KEPFIC, Advisory Council members. We appreciate you. We appreciate you for being a part of the Advisory Council and helping to gather information so that we can be as helpful as possible in terms of moving the needle and investing in Africa. So on behalf of our fantastic panel, Max, Dan, Shola, President Parker, on behalf of NAS, MEDA, Standard Bank, USAID, Mercer, we want to say a big thank you for joining us over the last hour. We hope it was informative, helpful, and we look forward to investing and helping you to invest more in Africa going forward. Thank you so much. And if we did not get a chance to respond to your questions, please do email us directly so we can make sure we can respond to it. So thank you. Thank you all for joining us today.